Everyone. This is Dan Surprenant, one of the managing partners at Surprenant Beneski. Thanks for joining us today on this webinar. We are trying to do more and more webinars during the COVID-19 crisis. Clients are asking a lot of questions, have a lot of concerns, and this seems to be the best and safest way to get the information out there. A lot of clients are doing their planning now. They're sort of motivated by the crisis and are thinking about things that they may have put off in the past. And we're here to help. We're doing everything virtually, phone calls and video conferences, and can walk you through the process as safely as possible. So one of the topics that we're bringing to you, today's topics, is clients are asking about the market, how the market's doing, what to think about their particularly retirement plans for our senior clients. So we're bringing you today financial advisor Anthony Salerno from Ameriprise Financial. How are you, Anthony?
Doing well today, Dan, all things considered. I hope you and your employees are well.
They are. I haven't seen most of them in a while. We're all working virtually. I'm home and they're all home, but I think everyone's spirits are up and we're keeping things moving. How are you and the family?
Everybody's doing well here. The disruption hasn't been too bad since I've worked remotely quite a bit over time. So like everyone else, we're trying to keep our social distance. And I want to thank you for including me on today's webinar.
Well, thank you for being here. I can't wait to get to these questions for the client. So let's jump right into that. First question is sort of very general. And this may be overly general and you'll break it down, but what should investors be thinking about during this time?
A good question. I think that's the $20 question. So I consider this market activity, these dramatic drops and swings, a market disruption. And history gives us some context here. We've seen a number of market disruptions over my career. I think I was several months into the business when we had the 1987 crash in the market over a Friday and a Monday, which I think still ranks as the highest percentage drop that the markets have ever seen. From there, we saw the burst of the 2002 internet bubble, similarly disruptive. 2008, it was not so long ago. I think everyone remembers the Great Recession and the market activity there. And then here we are again in 2020 with the COVID-19 driven market drop. So anytime you have a major market disruption, an investor is faced with really three courses of action. This may be oversimplifying, but I think it's worth putting it this way. Your first choice is to sit back and do nothing. Keep your mind on your long-term goals. Historically, that's been a pretty decent course of action. Markets generally recover, and over time, you get average return. The second option that investors can take is to liquidate. I consider that kind of a panic selling decision. And historically, that's been disastrous for investors. By the time they feel comfortable enough to get back in the market levels are no longer attractive. And using that strategy, you generally are there for all the pain of the market, but not there for any of the positive market activity. The third option is to find a way to accumulate assets that have been distressed in price, or to inject more money into your portfolio to take advantage of asset prices that are distressed. And historically, this is where the greatest returns are generated. It's interesting to me that as many of these type of situations as we've seen, and if you look at the slide on the chart, it goes through 8 or 10 different virus outbreaks. And if you look on the right-hand column, you'll see 12 months later, the S&P 500 in almost every case had excellent returns. So we know what history has taught us, yet when you get in the heat of the moment, investors generally are vulnerable to their emotions. So you can get afraid and you can do things that are going to be counterproductive to your longer return.
Sounds like it's an easy concept to sort of grasp theoretically, but tough to do. Easy to say, tough to stick to your guns when the emotion of the moment sets in.
Absolutely, and I've seen it work on the upside too. It's greed and fear. These are the two textbook forces in the marketplace. And when greed is prevalent, generally asset prices are overpriced, and when fear is prevalent is when you're going to get your bargains. So this moves to the next question is, well, how do you know when to buy and
Right.
when to sell? And if you're going to try to do any of that. So what we tell investors, what you should be doing in this market and during a market disruption is really the same thing you should be doing during more regular market activity. You should construct a portfolio that's built according to your risk tolerance. What we'll do often is we'll talk to an investor about risk, and we'll say, okay, if you had, let's look at a certain combination of assets. If you had a 60% stock portfolio, 40% bonds, to keep it very, very simple. During the 2008 recession, which is a very good stress test, right? Markets were extremely volatile and negative during that time period. If you had a 100% stock portfolio, you were down over 42% in 2008. If you had a 60-40 portfolio, you were down 28%. If you had a 40% stock, 60% bond portfolio, your drop would have been in the high teens, call it 17 or 18%. So we'll talk to investors about this, showing them what has been, among the worst market activity, and see how much heat they can handle. Once you arrive at that, you get your asset mix. But the biggest part of it to me is every 90 days we rebalance to get you back on formula. So if you're 60% stock, 40% bond, and the stock market were cut in half, now you're going to see that you're closer to 35, 65. What we do every days.
I'm sorry, Anthony, that rebalancing every 90 days, that's not just during the crisis. You're typically trying to do that with clients regularly?
We do that on schedule regularly. Every client gets a call every 90 days. We look at where your results are, and we rebalance the account without concern for the market levels. If the markets drop, we're going to be accumulating assets that have gone down in value, and we're talking the equity market dropping, and bonds have actually held up pretty well. So selling bonds, adding to stocks during this rebalance. The next 90 days out, maybe stocks have recovered a lot. You might shift back the other way. But what you're doing is systematically and unemotionally, you're acquiring assets that are low in price and liquidating assets that are higher in price, yet always staying within your risk tolerance band.
Seems like you're doing that mostly with the money that they've already got in the portfolio, not necessarily adding new money.
Absolutely. So, what we'll do when you come in, we're not going to leave some of your money uninvested. We want every investor to have a cushion. So this is money that gets you through 6 months or a year's worth of liabilities that you don't require any assets from your portfolio, right? So we're not going to invest your mortgage money or your kids' college money that way if they're a year away from college. But for any money that's longer term oriented, at least a year, and often 3 to 5 years and beyond, then we want that money invested to get those long-term returns that make it worth putting up with these kind of periods in the stock market.
I like it. You don't have to have a crystal ball to know when the bottom is. You can take advantage of the upswing when it happens.
No question. The best and brightest minds on Wall Street have never been able to call short-term market moves. So it's not likely that the average layperson is going to do better than that. So rather than trying to play a game you can't win consistently, you put in a methodology that's really built to weather any economic environment.
So it seems like there are opportunities here. What are you encouraged by? What do you see as a silver lining with all this?
Great question. So the markets are forward-looking. Today is an excellent example of things that can be intuitively challenging sometimes. So we come out with a 3 million plus print for unemployment, the largest by far that we've ever seen. And the market's up 1,000 points at some point during today, because the market already saw that number and knew it was coming. And what the market's doing is it's looking out at the flattening of the virus statistics. It's looking out at the environment post-virus. So what are we encouraged by? Let's say that the current trend that we've seen with the virus kind of slowing down in some of the places it first occurred extrapolates out here in the US, and in a month or so we're kind of closer to back to business. As we go into that third and fourth quarter, we're going to have extremely low interest rates. We're going to have extremely low oil prices. We're going in with a consumer that was in excellent shape before the disruption. And we're going in with very accommodative fiscal policy. The government is spending money to make sure everybody gets through this. We're also going to have a month or two's worth of pent-up demand, because after 3 or 4 more weeks of sitting at home working with the kids underfoot, we're all going to want to go out to a restaurant or get out of the house. So when you look at those tailwinds, historically, those have been very positive for equity prices. If you're rebalancing in here, don't worry about getting the bottom. Just keep accumulating assets that are less expensive. Over time, we're going to get a tailwind in those asset classes and give us an opportunity to rebalance the other way. Now this negative of market volatility has actually positioned you to generate returns.
What would you say to people looking to avoid real damage here?
So the best way to avoid damage is preventatively, right? So, and I know that doesn't help you if you're underwater right now, but just to take a step back, you don't put your raincoat on when you're already soaked, right? You put it on before it rains. So starting with the proper asset allocation is really the best way to handle that. The second thing that a lot of investors, particularly as you get older, should be considering or could consider are investments that have structural safeguards against market drops. So for example, certain annuities will guarantee you minimum lifetime income streams as well as an opportunity to invest in the market, and you get the better of those two channels. If the markets are sluggish for 10 years and you're in the middle of your retirement, you have a portion of your assets you don't have to worry about that for. You've kind of built in some defensive mechanisms to your portfolio by positioning assets into those areas. We also have a class of securities called structured notes that have similar safeguards in there, and yet they're not housed within an annuity. So there's a lot of moving parts there. That's really the kind of thing you want to sit down with your advisor and have those presented to you. And over time, especially when the markets are strong, and luckily enough, I felt the markets were overvalued in February, and I didn't see COVID-19 coming and being this disruptive, but I did feel that we were already at our year-end target for the S&P 500. And so we put in place some defensive measures for clients, and it just happened to look brilliant because of what happened in the next 6 weeks. But those are the kind of things you want to do when the market's strong, is position yourself with some protection on the downside through your asset allocation and through some of these structured products.
Anthony, you've been doing this for 30 years. You're with Ameriprise. Why are you with Ameriprise, and why should clients consider that?
Excellent question. So over those 30 years, I've worked for a number of different Wall Street firms. I did my corporate training in the late 80s in the Twin Towers in New York for Dean Witter before they were torn down. So I've seen the way a lot of companies work, and I've seen the good and the bad. So with Ameriprise, the first thing is they present the best value. My business is really twofold: financial planning, asset management. And they offer the best value in that combined space of any firm on Wall Street. You get more for your money. The second thing is Ameriprise has a culture of integrity. They are consistently among the least penalized firms on Wall Street, and they are among the best capitalized firms on Wall Street. One of a few firms on a short list that didn't require any TARP money in 2008. You have a good firm that gives you a fair value that operates with integrity. For these reasons, we consistently get the top rankings from J.D. Powers in customer service, customer loyalty, and customer satisfaction. The last thing that I would add is Ameriprise is not an investment bank. Unlike Merrill Lynch, unlike Morgan Stanley or Wells Fargo, we do no investment banking. So you're never going to get advice from us that has something to do with another component of our business. We're never going to tell you to buy an oil stock because we did the banking for that company, and we're reluctant to say something negative about them for fear of losing banking business. This doesn't mean we're right all the time, but we're wrong for the wrong reasons. And I think that's a conflict of interest that does occur in other places that can't possibly occur here because we don't do that business. The planning client and asset management client is all we have, and that's why that's so important to us.
Well, thank you very much. I think we're probably just about out of time. It's been educational for me, and I've always enjoyed working with you, and I hope that our clients and listeners got a lot out of this. If you have questions for Anthony, you can see his information on the screen, and I think you know where to call for Surprenant Beneski. So, Anthony, I just want to thank you for taking the time today during this crisis and giving us some insight.
Excellent. Thank you for having me, Dan, and I hope you and your family and your staff continue to be well and safe.
Thank you. You too. Have a great day.